I'm waiting for the music to fade out a little bit, Gabby. Hello and welcome.
I'm fading. Keep talking.
Hello and welcome. You're joining us live on the Investor Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance.
Okay.
And what you're going to get here is you're going to get absolute alpha in what is going on in the world of investing and financing, creating a life of freedom, choice, and abundance. But what you should not reasonably expect is that we will get the fade in and intro correct. That is the one. That is the one constant. That is the one universal.
There's a lot
constant.
we can do, my love, but apparently timing that is not one of them. You know, we're at episode 23 this year.
23 times. 23 times in a row we have cooked the intro. So I guess at this point,
maybe maybe this is what I planned it.
Well, that's just what I was about to say. I mean, at this point, that's just how it's done, right?
It's done. Let's just accept it.
So
love what is. Yeah.
So if you are here joining us live, please let us know in the chat. We'd love to see you. We'd love to be here with you. We'd love to enjoy this with you. Gabby, how are you today?
I'm good, man. I actually woke up with a spider bite on my face today. So
wow.
That's a fun way to start.
And I just got manned, bro.
Oh, you did? Sorry. Sitting on the couch and feeling very casual today, dude. Dude, man, bro. How are you, man?
I'm okay. Well, I'm feeling a little bit puffy. I'm a little bit unwell today. So, Hitesh, thank you for asking how we are. How are you, Hitesh? Really nice to be. Thank you for asking. I'm a little bit under the weather today, but I have just had a cold plunge to try and get all of the stuff stimulated so we can tackle today's. I avoided saying that. Thank you, Gabby.
I'll say it. It's slightly less weird, or is it more weird if I say it? It's probably slightly less weird.
Look, I think I think they're in the same area of the spectrum of strange. So let's leave the goose juice out of it for now. Let's leave it alone. All right, let's get started. What are we talking about today, Gabby?
We are talking about the US debt crisis. So as much as we were just having a little lull then for a couple of minutes, it's a serious situation, and we just thought there's a lot to talk about in terms of what is happening. And it's important, I think, as well for Australians to understand what is happening. Because particularly if you're not, like, if you're a finance person and you're interested in finance, you will probably be aware of what's happening. But if you're a normal everyday Australian and you are, experiencing cost of living pressures at the moment and not really aware of how that all interlinks at a global level, I think it's really important to start to think through, particularly like at the levels of the level that debt is climbing for the US is just, we've never seen something like this. So I just wanted to, bring that to the community to try and show them what they can do about it.
So I think it's an interesting point. I just sort of challenge one bit just slightly. You said that anyone who's kind of into investing in finance probably knows about this, but I would actually suggest that fewer people are paying attention to this than should be, even in the investing world. So it's not something that's happened overnight. Something that's been building and building and building for a while. And we have seen situations like this before, and it never ends well. Right. So just before we kind of get before we wade too deeply into the pool there. So let's kind of frame up what the situation is. So the US has been running, and we'll reframe this like we were talking about earlier, Gabby, in a second, but the US has been spending more money than it earns for some time now. And because it spends more money than it earns, it needs to borrow money in order to be able to pay its bills. And then the cost, so that not only are they spending more money than they earn, but then the interest expense on that debt goes up too, and that starts to take up more and more and more of the amount of money they've got coming in, and so then that starts to get out of control. And so, and Gabby, feel free to kind of do you want to kind of talk about this in like a household context? Or do you want me to frame it up?
No, I can talk about it. It's we were actually having a bit of a debate just before this, but I really wanted to try and bring home to people who may not really conceptualize what like national debt means and how to think about that and why that even matters. Because I think a lot of people, we all live in an economic society, so we all experience the challenges of fiscal decisions by nations. But what it kind of means in terms of like a nation building up debt, just to bring it home in terms of an analogy that might help. So the way that I like to think about it is just think about like an individual. So don't think about a country, just think about a normal individual. Just could be you, could be someone you know, could be your household. Just think of like a normal person. They have an income, they generate income, they have expenses to live their life. Generally speaking, most people have more income than the expenses that they spend, right? So that there's a little bit left over. They're kind of like self-sufficient in that sense. But what happens if your income might stay the same, but your expenses creep? And so you are at a deficit there where your expenses are more than what your income is. So, how do you make up that difference? Now, for people in that situation, if that's like the first time that you're experiencing it, you might go out and get a loan. You might get a loan from a bank, you might get a credit card, you borrow money from someone close to you, say, look, I'm $500 short this month. Can I borrow 500 bucks? That person has the choice of saying, yep, I trust you. I think you're going to repay me. If they trust you a little bit less, they might say, you know what? Yes, but let's do a little bit of interest on that. So it's similar, like if you go and get a credit card or you get a loan from a bank or something, they will usually charge interest on that. Basically, that's because they just want to cover the the a little bit perceived risk, but also that it becomes a financial strategy for them to be able to lend their money that they have to you, and so they get a little bit of a reward in that sense. And so you can imagine that individual that like, okay, this 1 week they're $500 short, so they borrow $500. But then the next week they're still short, so then they need to go and find more $500. And so they will either go to that same person, and that same person goes, yeah, cool, I still trust you. Like, here's $500, that's fine. Or maybe that person starts to go, I'm not sure. So then that individual has to go and find somewhere else. And they build up over time, they build up this habit and reliance on paying for things with debt. And so they have to keep finding places where they can basically, there's still demand for their um, their ability to repay that. So over time, though, you can imagine that builds up and builds up and builds up. And so the people who are owing, the people that the individual owes money to, so again, bank, credit card companies, individuals that lent them money, over time, if that individual is struggling to repay that debt, the lenders start to lose faith and they start to lose confidence in that individual, and they start to kind of retract and stop offering that debt to people. But that individual still has to spend money. They still have to live. And so it becomes this spiraling situation where they get more and more desperate.
Mm.
And that's kind of where the US is getting to now. They're getting to that point of other entities of which they borrow money from are starting to lose a bit of faith in the US, but their debt levels just keep growing, and their expenses keep climbing. They need to keep finding resources to be able to pay that. And so
Yeah.
I think that helps to anchor back what's really happening. If you just think about like an individual, what would they do if they were running out of money
Mm.
effectively? What would they do if they had climbing expenses and they've exhausted many of the resources that they can to be able to pay for things that they need to pay for? It gets quite tense, and there's a lot
Yeah.
of desperation that comes through from the individual in terms of trying to find ways to pay for things.
Yeah, 100%. Yeah, I do think about it in a very similar way. I think about it like, imagine if your household, if you had $10,000 of monthly income and $15,000 of monthly expenses, well, obviously your expenses are exceeding your income, and so what you might do if you weren't being financially sensible would be maybe go get a credit card or a personal loan to cover the shortfall. But then maybe because you don't change your spending habits, then you run up the credit card, but then you need to go get another credit card to pay off that credit card, and then you go
Mhm.
get another credit card to pay off that one, and so on and so on and so on, until you go into this massive debt spiral that you just can't get out of, and then that ends in effectively bankruptcy. Now, that is in effect how the bond markets work. Okay, so what we've just described there is the act of a household wanting to borrow money. Now, if the household is the US government in this case, and by the way,
Hmm.
we're going to talk a lot about the US here, but there's significant impacts for Australia and for Australian investors, and so we're gonna make sure we pull it back to that to make sure that's really really clear for everyone too, because it's super interesting how this is like what the second order effects of this are. So if the US is the household and it's seeking to get debt, where is it going to get debt from? Where does the US borrow money from? Well, what the US does is it issues bonds. Bonds are loans. They're transferable loans. So a loan is a structured agreement between two parties. A bond is a transferable loan. So and when it's interesting to kind of think about this idea of debt. Most people think that they get debt, but actually what they're doing is they're selling debt, right?
Mm.
And so what the US does is it sells debt and people buy debt and they buy the bonds. The bonds are the debt. And the US says, hey, if you buy this debt, we'll sell you some debt. You buy it, and then we'll pay you an interest on that. Have an interest payment on that, so that it's a yield bearing instrument. Now, the US has been seen as a safe haven. US treasuries have been seen as the kind of like safest thing that you can invest in. They've been deliberately and specifically non-volatile, highly safe, all of that kind of stuff for a very, very long time. But the problem is, if people lose faith in the security of the bonds, then people don't want to buy them,
Yeah.
right? If they think that they're not as safe as they once were, then they'll question whether or not they should buy them. Now, recently, Moody's were the last major credit agency to downgrade the US's credit rating. So Moody's up until recently were the last ones that still gave the US a AAA credit rating, and they dropped that. Just finding the details on that. They dropped that in, I think it was in April. I think it was that they dropped that.
Yeah.
And so that's one thing that kind of, and the reason they did that was basically because of the US's ballooning debt levels. So the US has currently got a debt to GDP ratio of around 124%, I think it is, or maybe 126%. It's around about that. It was 124% in December, so it must be more than that now. It must be more like 126, 128% right now. So the US's debt to GDP that's government debt to GDP, by the way, not total debt to GDP. That's government debt to GDP is around 100 and 100, we call it 126, 127%. I don't know the exact numbers to hand. And so credit agencies are saying, we're not sure that this is sustainable for you to go into that much debt. So they've downgraded the credit rating. Then also people who may purchase bonds are also questioning, is this a sustainable path? And so there's less people who want to buy the bonds. Now, the way bonds work is that price is inverted to yield. So what does that mean? That means if there's lots of demand for bonds and people want to pay a lot of money for the bonds, then the yield goes down. And if there's not much demand for bonds and people need to be paid a lot more money in interest to carry the risk of holding a bond, then the price of the bond goes down, but the yield of the bond goes up, right? It's a supply and demand ratio. So when you hear about, go on.
No, just quickly, it's basically, from what I understand, because they're taking perceived more risk by lending that money, right? So they're wanting more interest. They're wanting a
Correct.
higher yield for that risk.
Yeah, 100%, right? So they're basic. So the market, whether the market is made up of individuals, because individuals can buy bonds, and so do large institutions, pension funds, all of that kind of stuff.
Yeah.
For the buyer to look at a bond and say, look, at 2%, I don't think that's worth the risk, right? There's at least some risk of default, or at least there's some risk of loss, and it's not worth it. Now, that risk is seen in a whole bunch of different ways, including through currency debasement and a whole bunch of other stuff. So as bond buyers feel like they're taking on more risk, they're less prone to buy bonds unless the yield goes up. So what actually happens is bond auctions, and so they auction bonds off, and that gives us a real sense of the demand for bonds, or the demand for US debt. Now, bear in mind, US debt is the largest, most widely held and largest treasury reserve asset across the planet, right? So even Australian treasury, even the Australian Treasury is majority US dollar denominated in US Treasuries, right? So, and this has been part of the whole kind of like US dollar global reserve currency status, right? That's been part of how that's played out. We won't go into that too much because it'll get a little bit complicated. But basically, if there's less demand for bonds, bond yields go up. Now, the problem is if the US is spending more money than it earns and it needs to sell debt in order to pay for its bills, but it's also going to continue to run at a deficit. Currently, the projected deficit for 2025, calendar year 2025, is 1.9 trillion. So let's call that 2 trillion. So they're cranking up $2 trillion of debt a year. The current total federal debt level is 36.2 trillion, I think it is, Gabby.
Yeah, but
And
yeah,
which is
36 is. Yeah.
yeah, it's about 36 trillion, and it's increasing by about 4.27 billion a day, or 20 call it 30 billion a week, and 130 billion a month, basically, right? Is how much it's going up by.
It's a lot of
And
shopping.
that's a lot. That's a lot. And so the problem is, if no one wants to buy the US debt, who will buy the US debt? And so we start to then go into what we call a debt doom loop, sovereign debt doom loop. And it starts with weak bond demand, right? It starts with people not wanting to buy the bonds. If there's a lot of demand for US debt, then there's a big market for it, and there's a high amount of demand, and so the US can sell the debt easily. If it can't sell the debt easily, then it doesn't have an easy access source of funds to be able to fund its deficits, because again, remember, it's spending more money than it earns. So if it's okay, what I might do now is kind of walk through the kind of doom loop, and kind of explain how they all the pieces fit into each other. Okay, so if there's weak demand for bonds, i.e., fewer people or fewer organizations want to buy bonds, that drives yields up. Now, remember, it's a debt instrument. This is how the US generates debt. It sells bonds, right? And so if the yield on the bonds is higher, that means the interest that the US government has to pay on those bonds is higher. So that means the interest expense as a portion of the total government expense is higher. And so at the moment, the interest expense is a little over 1 trillion a year, and that is approximately about 25% of total tax receipts. So just the interest expense is around 25% of total tax receipts, right? So what happens if it starts with weak bond demand, so which less people want to buy the debt. That causes higher yields because people have to be paid more money in order to hold the debt. What that does is increases the interest rate that the US has to pay on the debt that it owns, which then increases the amount of expenses that it's got because the interest repayments are higher, which then increases the deficits. So it's going deeper and deeper and deeper. Its expenses start to run away from its income because its expenses increase faster than its income. So the bigger deficit, so it has larger deficits, right? So a bigger shortfall. So then it has to issue more bonds, right? But that also increases the debt to GDP ratio, which then increases the risk of increases the sovereign debt default risk, which means that less people want to buy the bonds, which means there's even less demand for the bonds, which then pushes up the yield, and they end up in a situation where people don't want to buy the bonds. So then, if no one else is going to buy the bonds, or there's a shortfall, what happens then? Well, then the US government will step in and start buying its own bonds. Right. So if we go back to that household example where, hey, if your household is running, your expenses are 15 grand and you've got 10 grand a month of income, and then you get credit card, and you just end up going through this debt doom loop, and then no one else is going to lend you any money. Just imagine if you could make your own credit cards to pay off your other credit cards, and you just made up the stuff out of thin air. So that's actually what happens. So the Fed becomes a buyer of last resort. They start buying their own bonds. And by the way, this isn't theory. This is already happening. They bought $10 billion worth of bonds last week, I think it was. Right. So this is already happening. Right. This is not a theoretical scenario that might happen. This is currently happening. Right. So and there's plenty of examples of it happening before. And what happens then is that's they need to print more money in order to buy their own debt. So they crank up the money printer, print more money, so they can go buy their own debt from themselves, right? So that they can keep the demand high enough to keep the yields at a certain level, because otherwise the yields go out of control. And that is a process called yield curve control, whereby the act of them providing the demand side in the bond market, they can keep yields artificially suppressed, right, by printing their own money and buying their own debt, let's just take a second to recognize how crazy that is, right? So when no one else will buy their debt, they'll print their own money and buy their own debt. What? Like, that's crazy.
To create the illusion that there's demand, right?
Yeah, yeah. And it transfers it from the P&L to the balance sheet, and it just does a whole bunch of other, it's like a right. So then what happens is the balance sheet expands, right? And there's more money printing. That the money printing creates currency debasement, which then creates inflation, right? Because they've got to print more money. And so there's more money pushing into circulation because they're buying their own bonds back. That then pushes inflation up, both consumer price inflation and asset price inflation and monetary inflation. They all go up. So then the Fed starts to want to raise rates so that it can slow the inflation down. But then that creates an economic slowdown, and so then there's more money printing to try and stimulate the economy, which then creates even more credit risk, which then reduces bond demand even further, which means the government has to step in and buy more bonds, and it just goes into an absolute spiral that gets out of control. And there's a few pieces in here to unpack there. But did that at first blush, Gabby, did that all make sense, or do I need to kind of dig into that a little bit further?
No, it made sense to me. I'm curious, guys, if you're here live and if that didn't quite click, like we've been talking about this, and so I understand the concept, but I just want to make sure that it is that spiraling doom loop
Mm.
situation and mechanics there. Does that click for everyone?
Yeah, let me go over it again in a kind of like sort of slightly simplified
Yeah,
fashion.
awesome.
So the US spends more money than it earns, and so in order to pay the bills that it can't pay because it doesn't earn enough money, it has to get debt. It gets debt by issuing bonds. If no one wants to buy the bonds, they have to they have to offer a higher interest rate to make the bonds more appealing. Then, if people still don't want to buy the bonds, they need to step in and print their own money to buy their own bonds to pay their own bills that they've got a shortfall for, which just sounds crazy. And so what happens is you have an expanding money supply. An expanding money supply causes monetary debasement, so the devaluation of the currency, which means that financial assets go up in value, and the people that have assets get rich, and the people that don't have assets get poor. And it increases the debt to GDP ratio, it increases the interest expense, and then they have to keep borrowing more and more money to be able to pay the increasing expenses. And so this ends up just going into this constant flywheel where they have to print more money to buy more of their own debt, which then increases the amount of interest repayments they've got. So they have to print more money to buy more of their own debt so they can continue to make the payments. So it's a pretty wild situation. But this is also not without precedent. Now, what's interesting here is the US is, as I mentioned, at around about 120, let's call it 128% or something like that, debt to GDP ratio at the moment. Now, according to a lot of different studies, there's a death zone, right, that exists for countries between 90% debt to GDP and 120% debt to GDP. Now, some economists say 90%, some economists say 120%. It's somewhere in that range where if a country hits that debt to GDP ratio, there's almost no way out, basically, right? And there's a few examples of this in the past. So the UK got to a debt to GDP ratio of 250%, but they were the world. Got to remember, they were the global reserve currency and the world superpower. And then around World War II, they just went into a huge amount of debt to try and pay for World War II, and as a result, completely destroyed their economy. Then they had to go through austerity, so basically massive budget cuts, huge amount of financial repression, inflation, lost the reserve status to the USD, all that kind of stuff, and basically went into free fall. Also, during the French Revolution, so the French got to, I think it was 90%. I'm just checking my numbers here. I think the French got to 90% debt to GDP, and that level of financial repression and what was happening there with them printing more money and going into more debt and everything like that was actually widening the gap between the rich and the poor, and that ended up with the French Revolution. Where the off with their heads kind of scenario, where the people rose up and started taking out the it started the French Revolution. So yeah, they were between 90 and 100% debt to GDP. Spain also had a similar situation where no one knows actually what their exact GDP was, but the Crown defaulted on their debts over 10 or 11 times. And because they defaulted on their debts 10 or 11 times, people stopped lending them money, and that led to the collapse of the Spanish Empire. The Dutch also had, in the late 1700s, or also had a similar situation. They had between 100 and 120% debt to GDP, and that they lost their economic superpower status to Great Britain. So that was the end of the Dutch Empire. So there has been no country has ever regained global hegemon status or global dominance if they've exceeded 130% debt to GDP. So the UK has sort of broadly survived, but they collapsed. They lost their empire status. And so this is a situation that is very hard to get out of. And in fact, Japan is a really good example of this, because they are at around about 250% debt to GDP at the moment, government debt to GDP, not counting private debt to GDP. Now, the problem with that is they are in a situation with huge amount of financial repression, huge amount of yield curve control. The yen is tremendously devalued because the government has to keep printing its own money to buy its own debts. But because it's printing its own money to buy its own debts, it has to keep its interest rates ridiculously low. Otherwise, it's going to go broke faster. And so Japanese interest rates are extremely low. And there was a whole kind of yen carry trade type thing that happened last year, where you could borrow yen at whatever 0.1% interest rate and then buy US assets. Basically, you get free money from Japan, take it over to the US, convert it into USD, and buy US assets. But the thing is, they have to keep the interest rate so low, otherwise it'll collapse the economy. And so they're just in this situation where the Bank of Japan owns 50% of its own debt. It's wild, right? It's completely crazy. And so what this can lead to is serious amounts of financial repression and serious currency devaluation over time. Before I kind of keep waffling on, Gabby, thoughts?
No thoughts. I just, whenever you kind of like, I know that this is happening, and I think we can go about our everyday lives and not pay a lot of attention to it, because there's lots of stuff to pay attention to these days. But every time I'm reminded of just like the situation that these countries have gotten themselves into, it's like how. And I think this is like it's a kind of a flaw with our whole economic system, that like there's actually as the planet Earth, there's no one above individual countries. So there's no like how.
Well, actually, have you heard of the BIS? Have you actually heard of the BIS?
Yes.
Yeah. So the Bank of
Did countries get in trouble?
Well, no, but you know what's interesting about the BIS?
Not that I'm like advocating for more regulation and
No,
governance and shit.
But at a sovereign level, it's a free market, right? So how does like the US get held accountable to this? Well, it gets held accountable by the fact that people will stop believing in the US economy, which is what's happening now.
The market decides.
Yeah, the market decides. The market decides. Which actually, so on Liberation Day, which in April or whatever it was, when Trump announced all the tariffs. That was a risk, that was a risk event. And so typically what would happen in those scenarios is that people would go risk off. And so they would seek safety with their financial assets. Usually, historically, when that happens, that means money flows into the US. So that means usually means that people want to buy more US dollars. People want to buy more US treasuries because they want to go risk off. So in a kind of risk off environment, the US has always been seen as like the safe place to go put your money. When the US announced all those tariffs, people went risk off and moved their money out of the US.
Yeah.
Bond yields shot up, dollar value went down, all of that kind of stuff, right? And so, so it is actually a situation right now that the free market holds countries accountable to that, and this is why empires fall. This is exactly why empires fall. Now, Neutral Rockets posted something in here. It seems like those closest to the money enjoy it before inflation hits everyday people who deal with the higher prices. And I just wanted to touch on that because that is actually something called the Cantillon effect. The Cantillon effect is an economic concept describing how changes in the money supply, especially when new money is created, do not affect all parts of the economy equally or simultaneously. Instead, the effects of inflation are uneven, benefiting those who receive the new money first and disadvantaging those who receive it later or not at all. So you're 100% correct. Like the Cantillon effect is really, really real. So, and you can actually look, let's not pretend that greater class divide is a good thing and stuff like that. Let's not pretend that it's not bad. Like it's shit, right? To be frank, that people are getting financially repressed and financially isolated through monetary debasement. But if you want to be smart about it, you can use this to your advantage. You just need to buy the right assets that means that you're going to benefit from the Cantillon effect. You're going to put yourself closer to the money printer, because the thing is, this is already happening. This is not like, oh, the US will end. If the US doesn't change something, it's going to end up in a sovereign debt doom loop. No. It is currently in
Already
a sovereign
happening.
debt doom loop. It's been in a sovereign debt doom loop since about 2019, right? And so we're in a situation now where it's happening. So you get to decide what are you going to do about it. Now, I've got actually a couple of charts here that I might show in as well before we kind of keep running on to a couple of things, if that's all right.
Yeah, awesome. Yeah. Um, I just wanted to add a comment there as well because was watching some Ray Dalio videos earlier,
Yep.
and his perspective is that the US basically has 3 years left to correct and fix its situation financially
Yep.
before, and it's I'm a big fan of his work, but it's hard to talk about the things that he talks about without being very doomsday, but sometimes
Yeah.
it can come across very doomsday. So he's saying, worse than recession, and
Well,
it's interesting to pay attention to because it can help you. Again, I believe in understanding and accumulating knowledge so that you can prepare yourself so that you can take action in the way that you need to. Less so than
yeah.
just getting caught up in the fear of it.
Well, let's come back to that, because I actually think that there's a huge amount of opportunity here as well, and I don't think it's going to be an explosion, so to speak. Now, is my screen sharing?
Oh, yeah, one sec. There you go.
Okay, so I just want to run through a couple of charts here really quick to kind of show what's going on here as well. So this is US M2. Now, as a reminder, M2 is kind of like broad money. It's not the broadest form of money, but it's the kind of in the US, it's the easiest reference to money that's flowing freely around the economy. US M2 is at the highest levels ever. Right. And if we kind of look at this trajectory it's on, I've added a little red line there. You can see that is going exponential. Now, even if you take out the bump, the kind of COVID bump, it kind of had that like spike above had a couple of standard deviations above the mean there. But you can still see it's on an exponential curve if you look at that red line. That is non-linear. That is a compounding exponential curve that is continuing to trend significantly upwards. So what that means is the US is continuing to print money at a faster and faster rate. And in fact, the US dollar, let me come back to that. The US dollar has had a 90% decline in its value since 1950, right? So it's lost 90% of its value since 1950. It's actually lost about 30% of its value in the last 15 years, I think it is. In the last 14 years, it's lost about 30% of its value. Since 2011, it's lost 30% of its value. So the US dollar is being devalued massively, but also every other currency is being devalued against the US dollar, including the Australian dollar is down 41% versus the US dollar since 2011, right? So currency debasement is like when the US dollar is the reserve currency of the world, everyone else wants to keep their dollar worth or keep their currency worth less or pegged very close to that, particularly if they've got an export-based economy. So Australia has an export-based economy, and so in order to stay competitive and so that people buy our stuff, we want to make sure that we're not getting too expensive on kind of like on a perceived nominal basis. And so Australia needs to keep devaluing its currency as well. Now, as we hit, there is a chance that the Australian dollar will strengthen temporarily against the US dollar, but then they'll have to go backwards over that. Now, let me just quickly flick through these charts for a second. So we can see here that the US, this is the US debt, historical debt levels up to present day. Now, the US debt is roughly at the same levels it was during World War II. So they have experienced these levels of debt before. The difference being, at the end of World War II, they could stop spending all that money because they were borrowing heaps of money to fund World War II. So they had to build planes and tanks and boats and all of this kind of stuff. At the end of World War II, they could literally just like stop spending all the money, right? So they didn't have to keep getting more and more debt because the things that they were doing, they stopped doing. So that was easy for them to cut that off. So it was kind of like a project-based debt explosion. And that's why it went up so quickly, and that's why it went down so quickly. And then you can see that it kind of trended, fairly, I would say, sustainably, in and around the kind of like 30 to 40% range between 1970 and 2011. And in between 2011, it went from about 40% up to where it is now, which that's just not a great representation because it's about 126% now. But you can see that it's continued to it's projected to continue, right? So this points to a systemic situation that is going to continue on and on. This is not a temporary thing. And so the reason I shared that is because, I think it's very interesting to see the relationship between the US dollar continuing to be printed more and more, the current debt levels continuing to go up, the fact that US dollar has lost 90% of its purchasing power over the last 65 years, and also, or 75 years, and also the Australian dollar is down 41% versus the US dollar over the last 14 years. Now, this kind of points to something pretty interesting, and a lot of people are worried about the US sovereign debt crisis being some kind of big explosion. They think about 2011, and they think about, oh my God, is this going to be another financial crisis? Is it going to be a big collapse? Now, the thing about that is that the 2011 was caused by a banking collapse. Now, Bear Stearns famously was one of the banks that went bust during the GFC, which caused a whole bunch of caused a kind of domino effect. But imagine if Bear Stearns was able to print its own money. Imagine if instead of going broke, it could actually just print its own money. Now, imagine if it had Bear Stearns dollars, right? We'll call them BSDs, right? So imagine if Bear Stearns, the bank, issued BSDs, and it had its own currency called the BSD. And then during the global financial crisis, when everyone came and said, "Hey, we want to redeem all of our money," and they didn't have it, they could just print more BSDs. Yes, it would devalue the BSDs, but they'd be able to pay everyone and they'd be able to stay in business, right? Pretty simple. Now, people might think that's a strange concept, but in fact, before the Federal Reserve in the US, banks did have their own currencies. So you're talking BS dollars.
BS dollars.
Yeah, true. BS dollars, right? That's probably what they should all be called, BSDs.
Yeah, they're all BSDs.
They're all BSDs. They're all BSDs. All political currencies are BSDs. But the banks in the US did have their own currencies. So there was like a St. Louis Bank of St. Louis dollar. There was like a Bank of Texas dollar, probably. I don't know. Like, I can't remember all of them, but there was a whole period where the banks would print their own money, and you had all these different currencies floating around in the US. And the reason that they centralized it, well, one of the reasons they centralized it was to create like a standardization of exchange between all of the different currencies across the United States. So, that's not an unreasonable concept to think that Bear Stearns could have had its own money. And if it had its own money, it would have printed all the money it needed to pay all the bills. Yes, it would have made the company sick, but it wouldn't have killed it. It would have made it sick. And so that's a kind of an easy analog, but because in the GFC, what actually happened was banking collapse. We had all these major banks collapse, and that caused a huge sudden jolt to the financial system. I think there's a very slim chance of that happening in this situation. What we're actually most likely to see is a a financial melt up, not a meltdown. Because people think of a crash and they think, oh my God, everything's going to break and everything's going to crash and everything's going to go down. But that's actually not the mechanism of how this will play out. Because the mechanism of how this will play out is there will be more money printing and more currency debasement. And so everything will crash up or melt up. And so the way that I think about this is they're going to go out with a whimper, not a bang. And so what I mean by that is it's going to be probably a 10. So firstly, I agree with Ray Dalio's statements. I've done my own research on this. My estimations of when we'll see the kind of climax, so to speak, of the US sovereign debt crisis is going to be somewhere between 2027 and 2030, right? So we're talking about in the next 3 to 5 years. That's basically where my research has led me, that it's going to be somewhere in that range. So let's call it by 2030, right? Because who knows, right? That doesn't mean that the US is going to explode by 2030, right? That's just going to mean that people are going to lose faith, and it's going to lead to a tremendous amount of more money printing and all of that kind of stuff. Now, when I say it'll go out with a whimper, not a bang, what I mean by that is it's not going to be this sudden event where it's like they've defaulted, because so there's two types of default. There's hard default and soft default. A hard default is when they say, sorry, we can't pay our bills. we need to close everything down. We need to shut the banks. We need to shut the government. We need to shut everything down because we're broke. Now, that can happen to countries that don't have their own ability to print money. That actually does happen. There are plenty of examples of that happening. I think Greece had that happen, even though they have their own currency. But there are plenty of situations where countries have just gone, oh, whoops, we broke it, and they've gone bust, and they've had a hard default. But a soft default is when you can print your own money, right? And you can just go, oh, we can't pay the bills. Well, let's just print a few more and print a few more. And what that does, that creates a long tail of a slow crash, right? But you've got to remember this is going to be a crash up, because the more money that gets printed, thanks to the quantity theory of money, that means that things will end up costing more. So everything's going to go up. So that's why we're going to see increase in inflation over time. That will potentially be offset by productivity. So a lot of the consumer price inflation will potentially be offset by productivity to a significant degree, because there's a huge amount of deflationary forces coming through AI. So from a consumer price perspective, as in like the cost of goods and services, we may not see an explosion in inflation. Right? I'm not. I don't know, but I suspect that what we'll see tremendous productivity gains offsetting the consumer price inflation aspect of that, because the cost of goods and services are going to get cheaper. But we're also going to see a tremendous amount of money printing, which is going to then shoot up financial assets. And so what that means is that things like real estate, things like Bitcoin, things like specifically the right kinds of equities to own, they're going to go through the roof, right? And that's why PE, if you look at the US stock market, PE ratios are at record highs, and everyone's like, oh, this is not sustainable. Well, so they're only at record highs because we keep printing more money, and so the nominal price of a share goes up when the earnings just aren't going up as fast. That's why. It's like, okay, like let's double the amount of money in the system, and okay, one share of something that was $100 is now $200. Okay, nothing else has really changed, but the earnings have stayed the same, but we've doubled the PE ratio. So this is going to continue to distort. Now, what this means for Australia, by the way, and I want to give you a bit more space to kind of explore some of these topics as well, but I'll just keep going whilst I'm on one. What this means for Australia is that Australia is a net importer of capital, and we're a net exporter of goods and services. And so what is likely to happen as the US government continues to print more and more money to buy its own debt, which is just insane, is the US dollar will continue to devalue. People will start to lose faith in the US economy. What that'll mean is that in order for Australia to stay competitive, it'll probably need to print more money as well, because it'll need to be able to export goods and services. And if the value of those goods and services is too high versus the rest of the world, it won't be able to export them, and that'll cause an economic slowdown. So it'll have to print more money to stimulate the economy, and to make sure that the dollar stays low relative to other currencies, not just the US dollar, but other currencies also, so it can stay competitive. That's going to create money printing. That money printing is going to flow into real assets like real estate. That is where it's going to go. Real estate is going to go through the roof. Mark my words. I can tell you that is going to happen with a very high degree of certainty. Right now, the other thing to consider in Australia is that iron ore prices are slowing down. We're starting to get to the tail end of the iron ore super cycle, because a lot of Australia's wealth has been driven by iron ore exports to places like China. China was going through a massive industrialization phase where it was just like building at all costs. Now it has overcooked that by a freaking long way. It has gone so far beyond that. That's actually created a systemic deflation risk in China. And so demand for iron ore is going down. That is also one of I think it makes up like 50% of our total export value. So what's likely to happen is we're likely to see some of the very strong parts of the Australian economy pull back, because there's less demand for those things on a global basis, which again is going to necessitate the RBA to be more dovish and to be able to want to print more money. So all of this points to more money printing. And again, these two forces come together, where we will theoretically have significant productivity and gains from AI, which will drive down consumer prices for the cost of goods and services and things, consumables, right? So the consumer prices of consumables may stay relatively stable. They may go up a little bit, they may go down a little bit, but they may stay relatively stable where they are. But non-consumables assets are going to go up in value because we're printing more money. So the non-consumable assets are going to go up in value. The consumable goods are going to go down in value in nominal terms, or stay about the same in nominal terms. because of productivity. And that's where we're going to find this equilibrium. And so I think that's going to lead to a significant amount of financial repression. The other thing to consider in here as well that we haven't touched on, which I think is super interesting for us to explore, is capital controls. Because once the US starts to break its own currency in a very visible way, people will want to start taking money out of the US. And so it will likely implement something called capital controls. Now, capital controls, there's a long history of countries implementing capital controls. China has had capital controls for a long time. They basically say you can't take money out of China. It's basically how it works. You make your money in China, you keep it in China. It stays in China. You bring money into China, it stays in China. So they have really strong capital controls, which is also why they banned Bitcoin for a long time. They've unbanned it now, but Bitcoin was banned. It was illegal in China because they could see that was a way that people could escape their capital controls. Now, capital controls have been put in place in many, many countries around the world to stop people taking money out of the country. And it sounds like a pretty Orwellian, arcane thing to do, but it's very common. In fact, in 2022, the IMF released a report about capital controls, kind of advising, if you kind of read it in the right way, it's kind of like advising governments when you should put them in. Basically, capital controls only really work if they're put in before everyone realizes that there is a crisis.
Mm-hmm.
You don't want to wait until there's a crisis and then try and put them in, because then there's still a window for people to get their money out, because they're like, what, capital controls are coming and there's a crisis? The flood of money accelerates. So if you want to prepare for a crisis, if you think that you're going to have a crisis, if you think there's a situation that may be coming where you're going to want to keep money in the country and stop people taking it out, then the idea as a country is you should put capital controls in place before that happens, so people normalize it and they get used to it, so that then when a crisis comes, that's not easy for them to move their money out. Now, capital controls can happen in a variety of different ways. They can come in the form of exit tax, or actually just fixed mandates that actually don't allow you to move the money out of the country. But even California in the US has implemented capital controls. So if you want to leave California, you have to pay an exit tax to leave California, right? It's crazy, right? So it's like, well, okay, yeah, cool. You want to take your money out? Oh, great. You're gonna have to pay a big ass bill to take your money out, and that disincentivizes people to move the money out of the country. It doesn't make it impossible; it just disincentivizes. Now, Australia has that too, by the way. You know, like we had to pay exit tax when we were leaving Australia, like to move some of our assets out of Australia. And so people do these, countries do these things already. So this is not a new phenomenon. But one of the key aspects of financial repression is not just yield curve control in a way that artificially keeps interest rates lower. So yield curve control typically keeps interest rates lower than inflation rates. So they print a ton of money that increases inflation, but then they keep buying enough bonds that the interest rate is low, right? So that artificially lowers the interest rate. So then you have negative real yields on bonds, right? Which basically means savers and bondholders get completely destroyed. So if you're saving your money, you go broke. But what that does is that devalues the debt. So they effectively inflate away the debt. So that's one version of financial repression. But then the second thing you need to do with that to make sure that people don't just take their money and just get out of there is you put capital controls in place so that people can't run away with the money. Does that make sense? What I've just said?
Mm-hmm. Mm-hmm.
So it's a pretty it's a pretty gnarly situation to be walking towards. But as it stands for Australia, I think Australians have a potentially big opportunity here. Look, the Australian debt to GDP ratio, total public debt to GDP ratio, including state and federal, is about 60%. So versus the US is about 128% ish, right? Thereabouts. I don't have the exact number again. So Australia's public debt to GDP is in a much healthier place, but it's also rising quite a lot. Because I remember about 2 years ago, it was 40%, or maybe even a year ago, it was about 40%.
Wow. Yeah.
Right? So it is actually, I think we do need to keep an eye on it. But because Australian government is in a better financial position, that is going to attract more economic interest. So capital will flow from the US to Australia, but Australia will need to stay competitive in terms of exports. So it'll need to print more money. It'll devalue the currency, all of that kind of stuff. And if you know that is going to happen, then all you need to do is put your money in the right place and watch it go up, right? So it's pretty simple.
It's pretty simple.
Yeah.
It's simple, but it's not. It's one of those things. It's like it is simple, but still, many people will do nothing.
Yeah, but I think so. Let's kind of pull that apart. Like people do nothing because they're confused and scared, right? And if you can simplify it down to two things are going to shape the next decade: artificial intelligence and money printing.
Mm.
That's it. And so, if you can understand those two things, that in a free market, all prices fall to the marginal cost of production, and thanks to AI, the marginal cost of production is going to trend towards zero on almost everything. Then
Mm.
you can understand that we're going to experience the largest deflationary force of productivity in our species. Fine.
Yep.
If you can also understand that because of spiraling debts and a whole bunch of other stuff, and just simply the fact that governments can't support a deflationary environment, that it's going to be more money printing. Understanding those two things helps you to navigate through everything calmly, because it's like, okay, so what kind of things are going to go up if there's money printing, and what kind of things won't go down with deflation?
Yeah.
Simple. It's actually pretty simple. So you can be like, okay, Australian residential real estate, yep, bang, tick, right? Like, so there's a tremendous amount of demand. It's not going to get deflated through AI anytime soon. And there's going to be huge capital flows into Australia. There's huge migration demand into Australia. Australia's going to need to print more money. Like, there's going to be money printing going out in the wazoo all around the world. Great. Okay. So that's going to make that's going to make house prices in Australia go up.
Mm.
Good. Easy. Very simple. Cool. Awesome. And then, of course, there's Bitcoin is a great aspect of that. And then, of course, there are actually owning parts of the AI ecosystem and infrastructure. So if you can own part of the deflationary force that is going to be driving, then that's a great position, because that's going to capture the value. So I actually think it is pretty simple. Now, and if you realize that it is that simple, then you can start to carve away the noise as it relates to being a property investor, because you can actually then just say, okay, cool. If that is true, and if I believe that there is going to be money printing, which you should, then you can understand that real estate is going to be a good investment over the next 10 to 15 years. So then the question is, how do you build a portfolio that actually makes sure that you don't get stuck? Right? That actually becomes a different question. Not just, should I buy property? Should I wait? Should I do something else? Should I it's like, no, okay, cool. This is a great move. Like, just get
Mm.
into it. How do you structure your portfolio so that you don't get stuck, so that you don't exceed your affordability basis? All of these kind of things. It's just like, okay, cool. Like, how do I play the game of real estate without running out of money with negative cash flow? How do I play the
Yeah.
game of real estate so that I can continue to buy more and more properties? It takes away all of the rest of the noise. Now, it is not as simple as just going and buying any house anywhere. It is not going to be evenly distributed. And by the way, if you want to understand more of the thinking around that, go back to the episode we did on the Australian real estate super cycle. I think it's the episode we did on that. Which we can link in the show notes. But it is tremendously bullish, right? It's a tremendously bullish signal if you know how to pay attention to it. If you are just going to sit there and say, "Oh my God, they're going to devalue our currency, everything's going to be bad, there's going to be inflation, there's going to be all this kind of stuff," then you can sit there and cry if you want, but that's not going to help you to get further ahead, right? It is not good that a lot of people are going to get left behind. But if you're listening to this, you've got an opportunity to go and jump on a boat on the right side and get across the river and take your family and friends with you. So I think understanding this is the first key to taking advantage of it.
Mm. Yeah, to your point about making sure you don't get stuck as well, because I think, like, clarified now that, real estate gonna go up. Good thing.
Yeah.
If you hold any asset in real estate, it is likely to grow in value over the foreseeable future, right? We all kind
Yep.
of fundamentally understand that. So you can buy an asset that will grow, good result, but you could buy another asset that is an even better result because you've been smarter about it. But it's also particularly an asset that has not locked up your personal financial capacity to continue to buy assets. Because I think this is something
Yep.
as well. It's like, if you go out and buy anything, yeah, you might get a good result and it'll go up. But the reality is that unless you are fully loaded already and have like millions of dollars of cash that you can just buy things in cash, and the financial requirement of like lending doesn't apply to you because you've
Yep.
got piles of cash that you can use. The reality is like, you as an individual, your lending situation, your income situation still impacts your ability to get more lending so that you can buy more assets. And so if you
Yep.
want to keep building your asset base, you need to buy things that are not going to stop that from happening. So it's this beautiful
Yeah.
dance of making sure that they both harmonize together.
Totally. I think there's a couple of things that are really, really true in there. Number one, you can't just buy any property. Like over a long enough time horizon, like over the next
Mm.
10 to 15 years, you're going to be just fine. You're going to be just fine, right? Like
Yeah.
as long as you don't buy some, you know, shack out the middle of Upper Conductor West or something like that in the middle of the outback, right?
Yeah.
Then you're going to be just fine. As long as you're buying sensibly over a 10, 15
Yeah.
year time horizon, you're going to be just fine.
Yeah. That includes like if you own your home
Yeah.
now and you want to hold on to that, like that will
Yep.
do well. Yeah.
It'll do just fine. Yeah, buying a home is a great wealth decision as well, as long as you can afford it. So the difference though is buying the right property for your portfolio at the right time
Mm.
can actually be the difference between you doing okay and you doing fantastically well, right? So yeah, over a 10 to 15 year time horizon, you'll be just fine. You could buy, you could buy in any kind of like reasonably sized economy with some, that's thriving and not declining, and you'll do just fine, right? But there's a difference between doing okay and doing fantastically well. And so I know someone that I spoke to recently, and they bought a property in Sydney in 2017, and in 2025 they sold it for, actually, now that I think about it, I know two people that I've spoken to recently who bought properties in Sydney. One was a house and one was an apartment, and both of them sold their properties this year for the same price that they paid for them, give or take $5,000, right? Like
Yeah.
one was about 7 years later, and one was about 10 years later.
Wow.
Now you can't tell me that that's a good move. So that's evidence that you need to make sure you're buying in the right properties in the right place at the right time. But then the right property for you is going to be dictated by your individual circumstances, right? Let's say you've got a savings rate of $1,500 a month that you could put towards property. Then buying a property that is going to be negative cash flow by $2,500 a month is going to be a very bad idea. And also if you don't understand how to structure your portfolio to get from one property to the next, so that you don't get stuck, or so that you don't run out of borrowing capacity, or so that you don't run out of savings, or any of that kind of stuff, then that's the difference between you buying one property and going, okay, this is going to work out pretty well for me over the next 10 years, and you buying 5, 10 properties over the next 10 years and doing fantastically well. That's the difference between you being, a millionaire and a multi-millionaire, maybe even a decamillionaire, right? It is a big difference, right? And so I think people need to be very cognizant of that this is not just by, John McGrath, no relation, by the way.
Believe it or not.
Yeah, believe it or not. I read a quote from him years ago where he said, real estate is great. Just buy anything and wait 30 years or something like that. Something like that.
Right.
Just just wait 30 years and you'll be fine. And it's like, that is a pretty shitty investment strategy. That's a pretty shitty investment strategy if you ask me, right? Like you need to be more incisive and more surgical in your approach. And if you do that, then you can massively benefit from these things. So, like the way just sort of circling back to this, I don't get concerned when I think about the US sovereign debt doom, because it's happened before. It's happened hundreds of times in history. It's how the Romans fell. It's how the Renaissance. It's how the Renaissance ended. It's how the French Revolution ended. It's how the Spanish Empire ended. It's how the Dutch Empire ended. It's how the British Empire ended. It was all currency collapse, basically, at the end of the day. And so it's all happened before. And we've continued to thrive beyond that. What'll happen is there'll be a change. There'll be a rotation of the world order in some way, shape, or form. And look, a lot of people say, is it going to be US and China? China's not without its problems either. China's a bloody mess at the moment.
China can hear you.
China can hear me.
Sorry, China.
We like you,
China.
China.
Hear you. Come on.
They could definitely hear me. So, but like there's a little bit more to it than that. But the EU is also in real trouble, right? Like, because Greece is like 160% debt to GDP. Italy's at about 147% debt to GDP. Germany's at about 38% debt to GDP. But as the EU, they're in a situation where they've got all these different states that are different countries that are performing in very different ways, and they're also going to have to reinvigorate the European economy, because the European economy is stagnating significantly. Now, some people see that as an opportunity. Maybe it's time to enter into the European markets, maybe, or maybe it's just dead, long time. Who knows? But you've also got other parts of the world which are also thriving. Did you know that for the majority of the last 1,000 years, India was the global economic superpower? Most people don't know. Most people don't know that. And by the way, did you know that the only reason, or maybe not the only reason, one of the main reasons that India lost its economic superpower status is because it chose the wrong currency. It chose the wrong standard to be on. It chose the silver standard, not the gold standard. And because the silver standard, because silver became much more easy to produce, the silver suppliers got inflated, which then destroyed their currency, which destroyed all their purchasing power, which destroyed their economy, which allowed the British to overtake their country, which is crazy, right? So that's another example where by having a weak monetary standard, i.e., something that you can create more and more of, something that's very soft money, like the US dollar, they can print more and more of. Because India was on a silver standard and not a gold standard, and gold was harder, i.e., it was harder to produce, and there was less, had a better stock to flow ratio than silver. Silver was produced in greater quantities, which devalued silver, which meant that the Indian sovereign Indian monetary standard got devalued, which meant their purchasing power went down, which meant they weakened as an economy, and so on and so forth. Right. So this is another great example of how that plays out. So this is all played out before, and I think it's going to continue to play out. And by the way, it's not going to be an even ship. You look at Thailand. Interestingly enough, Thailand, the Thai baht has strengthened very significantly against the US dollar because it has said, well, we're not going to devalue our currency. So China was looking for the US dollar to devalue so that China could print more. The Thais said, no, we're not going to do that. The Thais have actually got, I'm not sure if it's still true, but I remember about 10 years ago, they had the largest amount of gold per capita than any other country in the world. They had huge gold reserves considering their country's size. And so the Thai baht has actually strengthened versus the US dollar. And so it's actually positioning itself to pick up some of the economic slack and maybe raise the standard of its own people by having an increasing value of its currency. So the people that have got, so the Thai people that have got Thai baht can actually buy more with their Thai baht, and they can start to become consumers and start to buy more and increase their standard of living. And so what we'll see is we'll see change. Now, change isn't something to be feared. And again, I don't see this as being a big collapse. I saw we had a couple of people sending questions before this episode when we announced the topic. And so one of the questions was, should I wait? Should I wait? What does this mean? Should I wait to buy property, or should I wait to invest, or should I wait to do something? It's like, well, no, why would you? Because what's going to happen is you're not waiting for a crash. You're not waiting for this moment where everything goes down. What's going to happen is it's going to print more money and everything's going to go up and 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 up. And so now more than ever, you want to get in right now on the ground floor as soon as you get the information to make sure you understand, to make sure that you can benefit from all of that increase.
And to your point, it's like it's not likely to be a hard crash. So a lot of people, I think because, it was a very steep, dramatic time when the GFC hit, that everyone is, I think, maybe anticipating that something similar is going to happen. And so they're waiting, in whatever sense, they're waiting for some kind of crash so that they can time out. And this has been, we've been doing this kind of stuff for 6 years now. 6?
Yeah.
6 years. And it's a forever question from people. Should I wait? Because they're always trying to time something. Whereas if at the start of that first year, if you had have done the thing, you would have experienced 6 years of benefit by now.
Yeah.
And I think it's like that hard crash may not come in the way that people are expecting. It's more of that soft continue to print.
And people are going to miss out, by the way. People are going to miss out. They're gonna look back and they're gonna regret it. They're gonna regret not getting involved, right? Yep. Particularly in Australian residential real estate. It's not even just like all you have to believe is the money printing story is true, and that should just be enough. But if you couple that with also, chronic undersupply, huge amount of migration, all that kind of stuff, it's a no-brainer. And the only thing that's going to happen is you're going to miss out. And I want to move to questions in a second because there's some great stuff in the chat there. So by the way, whilst I'm still just waffling on here, if you have questions, drop them in the chat because we've got a little bit more time today. So we're going to go through those questions. We'll start to answer those questions. So let's get a conversation going. So start to drop those questions. We will hit up all the questions that you've already got in there as well, but chuck some more in there and we'll get through them. So, like now more than ever, like I was saying to you just earlier today, actually, I think it was, that 100% or very close to 100% of all of the conversations that I have had with parents in 2025, when I've asked them about their goals and their objectives with investing, at least one of the primary factors, aside from like have a better retirement, The other primary factor is to try and set their kids up because they're worried about what's going to happen with their kids because they can see that it's getting harder to get ahead and things are going to be harder for them. Now, back in 2019, that wasn't the case. All of the conversations that I would have would be based around prosperity. Oh yeah, I want to have this luxurious retirement. I want to retire early and I want to retire rich and I want to travel the world and I want to, everything's going to be great. But now the conversation is much more around I'm worried about what life is going to be like for my kids. And therefore, I need to invest so I can help them to get ahead. And this is only going to accelerate. If you already feel that way, this is only going to accelerate. I did some research last year that pointed to the fact it's getting 12.4% harder every year to get into real estate, which basically means it's getting twice as hard every 6.25 years, which is crazy. And so if you wait, you're only going to make it harder for yourself and your family. So should we start working through some of these questions?
Yeah, I'm trying to figure out. Do we go back from the start?
Yeah, let's go from the top. So
Neutral
Rocket says,
I need to know Neutral Rocket's real name.
Yeah, so do I. Is it banks who buy the bonds or mostly everyday investors? Well, it's a really good question. So do banks buy bonds or mostly everyday investors? It is a mix. Now, most bonds are bought by actually foreign governments. And this is actually one of the big issues with the bond market is other governments are saying, we're not sure that we trust the US economy anymore. So it's actually sovereign debt holders. It's people like, the People's Bank of China, the European Central Bank, all of these kind of things. It's central banks that buy US treasuries. That's the biggest market. That's the whole kind of like US dollar hegemony kind of thing. Second to sovereign debt holders, it is institutions. So think banks, insurance companies, pension funds, all of that kind of stuff. And then you start to move towards retail. Now, what's interesting about that is back around World War II, when they were trying to raise money to fund World War II, they did all these campaigns with major celebrities, people like John Wayne and all this kind of stuff. And, people like, I can't remember, someone like the famous like Frank Sinatra types, not Frank Sinatra, but people like that were like singing songs about buying bonds. And
were
I think it was
they
like
really?
I think Bing Crosby. I think I saw a clip of Bing Crosby singing a song about buying a bond. You can be the man who buys the guns and planes, and it's like it's hilarious, right?
Far out.
Yeah. John Wayne on television, like
they're probably not far off.
You can buy a bond, and you can be helping yourself and helping your country, and that's got to be a good thing.
We'll see ads on social media soon, I reckon.
Yeah. Lucille Ball. I saw an ad with Lucille Ball in it. So like there was all these major celebrities that were pushing consumers to go and buy bonds, right? So definitely there's a retail market for it, but the biggest market is sovereign debt holders, right? So it's other countries. So other countries are the ones that are actually saying, you know what, we're not really sure that we want to own this debt any longer. This is too risky. Yeah. What's actually interesting as well. Sorry, Gabby. But what's actually interesting is the average duration has shortened. So 30-year and 10-year and 30-year bonds are becoming the least desirable. So they've got the highest yields on them because people are like, we don't know where the US is going to be in 10 to 30 years. But they're willing to take on short-term debt. So short-term bonds have got quite low interest, quite low yields on them because people are willing to hold it short-term. So like, yeah, okay, the next year or so is probably okay. And so they're taking on short-dated debt, which is actually something that emerging market economies do. Like, small countries in Africa and stuff sell overnight bonds and short-dated bonds. So the US bond market is starting to resemble more like an emerging market bond market, which is interesting.
Sorry, I missed what you said at the start of this because I was reading the questions. But did you mention about super funds?
No, I didn't mention. I mentioned pension funds in US, super funds in Australia are buying treasuries.
Yeah, because I think like historically bonds have had this reputation as being one of the safest assets. So I think particularly like if you go to a financial advisor in the past 10, 15, 20 years, it's a typical asset type that they will suggest that you invest in because it is very safe. It's like it's low-ish yield, but it's not likely to tank. Do we know if super funds historically buy bonds?
Look, I don't have the specifics, but I'd suggest that they would.
Don't know.
No, I'm sorry. I'm sorry. I'm sorry. Let me.
Tell me what Australian super invests in.
Yeah, no, but I'd suggest that they would. I'd suggest that they would. But
Yep.
there's only a couple of investments that are guaranteed to lose you money, and that's cash and bonds. Maybe there's something else that I can think of. You'll have to leave it with me. But those two are like the worst possible investments that you could have. So savings in cash and
Mhm.
bonds, government bonds. They're the only things that are guaranteed to lose
Yeah.
money,
Yep.
which is crazy.
Which is such a
Um,
pivot for as an asset, because again, historically, it's always been one of these like safe
yeah,
things. Yeah.
totally. Yeah, but since 1971, when everyone went off the gold standard and started the money printing fiasco, that's when it all went to pot, right? So before
Yeah.
that, actually might have made sense, because things would hold value because we weren't devaluing the currency. But these days, that doesn't make any sense, or it hasn't made sense for about 50 odd years.
Yep.
Okay, so we covered the
Another
Cantillon
question.
effect. Yep.
Yeah. Hang on.
Do you think that the US being reserve currency lets them have higher than normal debt to GDP without collapsing? Are they exporting their inflation to the rest of the world? Yes. Short answer, yes. The challenge with that is if they abuse that, then people will stop wanting to own US dollars. So the US's biggest export is US dollars. So what happens? The way to think about this is the US is a net importer of goods and a net
Mm.
exporter of US dollars. So they export dollars to the world in exchange for goods. And what that does is that keeps the US dollar in circulation broadly and used broadly for the exchange of goods
Mhm.
and services. That kind of keeps its US dollar reserve status in play. But the problem is if they abuse that power and if they print too much money and people start to go, we're holding these US dollars and they're becoming worth less and less and less over time, and people stop wanting to use it, then that will break. So they are exporting their inflation to the rest of the world, and that's also why when I look at the US and I go, okay, they're going into a sovereign debt doom loop, they're going to go into a monetary inflation, bonanza. That's why I'm like, okay, that's going to have a massive effect on Australia because that monetary inflation bonanza is also going to spread to Australia. It's like a contagion that's going to spread around the world, and it's going to cause other countries to do competitive devaluation is the term, competitive devaluation, where in order for everyone to stay competitive with each other, everyone is going to race to devalue their currency so that they can continue to stay competitive and export, because otherwise they'll have their economy will implode. And so the catch-22 with that is if that happens at the same time, then the US dollar still may be worth more than most of the other currencies. So it's a bit of a balancing act where the US dollar is at risk. But it's not necessarily a foregone conclusion that the US dollar will stop being the global reserve currency. In fact, one of the things to consider is the fact that is stable coins. So stable coins, US dollar denominated stable coins, which is basically a tokenized version of the US dollar, right? If you think about it like that, like a crypto version of the US dollar, where it's backed by US treasuries, by the way. So they buy treasuries and issue dollar denominated tokens, right? So you have like a USDC circle, USDT tether. They are the most in demand crypto products around the world, because if you're in, I don't know, Brazil, right? Do you want to own US dollars? Yes. Do you want the portability and the ease of access and the ease of transportability of having it in a crypto wrapper? Yes. And so they're actually the highest demand things, and that's actually one of the big sources of demand for the treasury market as well, because Tether and Circle are just buying up US treasuries and then using them to back the stable coins. So
Mm.
that in and of itself may continue to keep the US dollar as the dominant global reserve currency, but it doesn't change the fact that they're exporting their inflation to the rest of the world.
Cool.
Sweet. Next question.
Next question. Question
Olivia?
from Liv. Yeah.
Yeah.
Well, hang on.
It's a great question, Liv. So if we're all playing this game against this inflation/dollar devalue, as investors, what's the best way to beat it or to stay on top of it? And then if you can't beat it, what's the best way to break even? So it's a really good question. And we've actually covered, we did an episode on hurdle rates that we can link in the show notes as well.
Mhm.
But it's a really great question. And if you were to ask me, what are the top 3 assets to invest in order to not just beat but benefit from, to be on the receiving end of all of the benefits of all of this monetary debasement and monetary inflation, number one would be Australian residential real estate. Number two would be Bitcoin. And number three would be what I call exponential age equities, right? So basically, companies or equities that are highly exposed to all of the deflationary forces, or the kind of like where we're going in the future. So everything from robotics to space to AI to all of that kind of stuff, that they're going to be significant beneficiaries of all of this, because a lot of value is going to be extracted from the rest of the economy and accrue to those companies. So if you can get that play right, that makes sense. But in reverse order, the equities is the highest risk, highest chance of failure, because you could pick the wrong company and you could stuff it up and you might go wrong, or a company might go bust. So there's huge upside there if you can pick the right equities, but it's also quite high risk. So you're just going to be very careful with doing that. Bitcoin is way more volatile than residential real estate in Australia, but it's also more liquid. So there's some benefits there. But it's also the best possible way to take your money out of the system. So it's tremendously powerful. And then residential real estate in Australia is the best risk-adjusted return asset that I can see out there. Now, that is not, I'm very specific about residential real estate in Australia. So that doesn't mean property around the world, and it doesn't necessarily mean commercial in Australia either. Commercial has some great upsides in Australia in regards to yields, but you've got to be considerate around growth as well. So I think residential real estate in Australia represents, to me, the best risk-adjusted return opportunity out there. So that's how I would think about that. And if you can't beat it, well, I mean, you should just beat it, basically, because in order to break even, you need to be getting at least 14%, subject to whatever the monetary inflation rate ends up being if they keep printing at this rate. So you need to find something that's going to give you a risk-adjusted return of 14% in order to make it make sense. Now, the NASDAQ, by the way, so you could invest in the QQQ. And none of this is financial advice, by the way, but the QQQ has over the last 5-10 years compounded at roughly about 20 to 22% per annum. So you're going to beat your hurdle rate doing that. That's an index. But you need to be very careful and considerate around the approach here, because there's some points of view that capital may rotate out of the US markets into other markets, like the European market and stuff like that. There could be some change there. But if I was to kind of stack them and rank them in from most interesting to least interesting, or top three, would be residential real estate in Australia, Bitcoin, and then exponential age equities. So that's how I would seek to beat that.
Awesome. Yeah, I think with like that mix as well, what I think is important to remember is like residential real estate in Australia might be the top of that list, but not always accessible for people to just go out and buy another property. But the other two, there's a significantly lower barrier to entry to be able to invest in. So like you can go and buy Bitcoin. You can't buy a Bitcoin for, what is it now? Like 110
160 Aussie, something like that. Yeah, 165 Aussie.
So you can't buy a whole Bitcoin, but you can buy one tiny Satoshi for whatever the math works out to be now. But basically, as much as you have right now, you could have $50. You could invest in Bitcoin or shares as well. So it's, if you are in between being able to afford an investment property or a PPR or any kind of real estate, think about these other assets as well.
Yeah, totally. And same thing goes with equities as well. We bought, I think our average entry price into Palantir is like $27 or 20 bucks or something like that, and it's now worth 140, right? And so if you do your research, you can find the right opportunities to kind of take small amounts of capital, make it into large amounts of capital, so that you can then deploy that into a better asset, which is Australian residential real estate. So it could be a stepping stone way to get there.
Yeah, which I even like that idea for people that are wanting to buy their home.
Yeah, exactly.
Don't try and save up your deposit. Use other ways that you can build up your deposit to
Oh my
faster.
God, 100%. Like you could how much can you save in a year? So let's say you're on $100,000 and you're getting taxed at 35%. Right? So that means you're going to take home $65,000 in a year. Let's say you're saving, let's say that you're saving 20% of your income. That means you're going to save 13 grand a year.
20% is a lot too, but yeah.
Yeah, 20 exactly. 20% is a lot. Like 20% is a lot. 20% is a very high savings rate. That's $13,000 a year that you're going to be saving off $100,000 income, right?
Yep.
Okay, so let's say that you need $100,000 to go buy a property. $100,000 divided by 13,000. That's going to take you 7.69 years to save up
Mhm.
on $100,000 salary. Like that, like $100,000 salary is pretty good, right? So some people earn more, but some people earn less. That's pretty good. It's going to take you 7.7 years to save up. But the problem is, in 7.7 years, property prices will have doubled. So you won't need $100,000. You probably need $200,000. You know what I mean? Like, or at least 150 or something like that, or 160 or 170. And so you can't do it. You have to get smarter. Whereas you could take 20% of your income, you could invest it into assets like again, none of this is financial advice. Go do your own research. You can invest it into assets like Bitcoin, or like an index fund like the NASDAQ, or like some equities or whatever. And then you can increase your capital over time. That's how you can start to get ahead, because you can beat the hurdle rate. So,
Couple more questions.
couple more questions. Yeah, a couple of comments in here as well. Neutral Rocket says it's much more painful for a government to default on its debt than to inflate it away. Absolutely. No. By the way, one way that countries can escape a debt doom loop is austerity. They can just say, okay, well, we're spending more money than we earn, so let's cut expenses. The problem is no government wants to do that, because no government will do that, because it'll make them unpopular. So one way to do it would just be like, literally, like, okay, well, how much money are we making? Let's cut. The
I mean, we saw
challenge with
what
that,
happened with Doge and
yeah,
all the flack that Elon was just put through in the last 6 months or whatever,
yeah,
in terms of
100%.
like your mission is to go out and cut spending. Now, has that had a benefit?
Nowhere near
Financially,
enough.
maybe, but
Nowhere near
it's
enough.
like
Nowhere near
the
enough.
amount of criticism that I guess governments go
Mm.
through when they decide that they're going to cut expenses versus like trying to increase the other
It's
side is
also
huge.
it's also not that simple, right? So if
Mm.
it's easy to say, okay, well, let's cut expenses. But if you cut expenses, you're going to have to end up cutting critical services like welfare, health, social
Yep.
services,
Yeah.
these things like pensions. So what that necessarily does is that starts to hobble the economy, because people start to preserve more of their money. They spend less, all this kind of stuff. And so you actually end up with an economic slowdown. So that ends up creating less revenue for the government. So you cut your expenses, but you also cut your revenue, right? And so then you have to chase your expenses down as your revenue is going down. So you go through this you go through a compounding contraction when you start to. It's not just as simple as like, let's cut our expenditure, because then the government will collect less money. So then it has to cut its expenses more, which means it collects less money, and you have to cut. And there's a curve to it, right? There's a point at which you've cut as deeply as you can cut, and you found the equilibrium between income and cutting. But it is pretty bloody deep. Let's just put it that way. It's pretty bloody deep. And so no government wants to do that. And so it's too painful and it's too unpopular. So it's way easier to just hit the money printer button and just let everybody else deal with it in the future. So
Yep.
sweet.
Couple more questions. So,
Yep.
doesn't China hold a massive amount of US bonds?
Yep.
Yep.
Yes.
Yes.
It does.
Correct.
Yes, it does.
Yes,
But also,
it
it's buying
does.
less and less. So it's actually one of the major buyers of US bonds that's actually reducing its bond buying program. So it's buying less and less US bonds. And so, part of the let me just quickly. I had some facts here around who was buying the bonds, but China's been one of the big ones that has pulled back from buying US treasuries, but foreign demand generally. So China, the EU, other countries as well, they're all pulling back and buying less US treasuries. They still have lots of them, but they're buying less, and that's part of the issue. That's why the bond market is weakening, and again, that's why it's firing up this flywheel even further, because even as I mentioned last week, the US government bought $10 billion worth of its own bonds, printed $10 billion and bought its own bonds, bought its own debt, which is crazy. So sweet. Cool. Kishan has asked, can the Fed buy mortgage-backed securities from commercial banks as well as government bonds? I'm not sure. I have heard about this. I think that they have the capability to do it, right? To buy mortgage-backed securities. but I don't think it's like a done thing. I think that would need to be like something that they could do. I'm not familiar enough with that, to be honest, but I think it is something that they may have done in the past or can do. I have heard a little bit about that as a way for them to kind of be able to support the real estate sector in the US, that they can actually buy the mortgage-backed securities and kind of be that defensibility creditor, so to speak. But I don't know enough about it to really comment on it. Shampoo Time has asked, what would happen if China sold all of its treasuries? If China sold all of its treasuries, I think it would lose a lot of money. Because imagine if you flooded the market with something that people didn't want to buy, that's only going to drive the prices down. So at the moment, they have it as collateral that they can use and kind of keeps them in a kind of credit-worthy position because it's collateral on the balance sheet. If they were to sell it all, they would drive the price down. It would spiral the price of US treasuries down. And I think that would be net negative to them and also the US. So I don't think it's something they're going to do. I wouldn't imagine that would be the case. They'll probably just buy less and then, kind of deal with it later, I think. So cool. Anything you think we should have covered today that we haven't covered, Gabby?
No, I think it's funny. It's like every conversation we have, it does come back to investing. But I think that's just where we're at. It's not like
Yeah.
we're talking about these different topics, and it's like there's a lot changing in the world, and really getting in front of that, the best way to do that is to invest in whatever way makes sense for you right now. And
Yep.
I think these topics are always going to come back to like the best thing to do is to try and set yourself up financially, because you don't want to get
Yeah.
in a situation where we don't know what's going to happen here. We don't know what's going to happen with technology and inflation and deflation, and like, we don't know what's going to happen, but you are better off to have a strong financial base than not.
100%. 100%. And look, the reality of the situation is it really does come back to investing, because everyone exists in a system that is falling apart. Like the value of your money is going down. Like it's everything is falling apart around you. And so you've got an opportunity to kind of change that position for yourself and for your family. And so, yeah, you should spend as much as you need to live a good life. And then you should take every single additional cent that you've got and get it working for you to get yourself out of the quicksand. And that should really be the modus operandi. So,
Yep.
Awesome.
Cool. Great.
All right. Let's leave it there. Thanks for joining us today.
Yeah, we actually, guys, next week Goose and I are heading away for the weekend. I'm remembering now because I often forget. I'm like, how do I tell everyone? So we're going to do the live session next Friday, but it's actually going to be a couple of hours early. So I think it's at 9 a.m. Sydney time. Now,
9 a.m. Sydney time.
9 a.m. might be a shitty time for everyone. Understood. If you can join us live, it would be awesome because we love this back and forth with you in the chat. If you can't join live, that's okay. Check out the replay. But yeah, 9 a.m. next week. And if you've gotten value, as always, please share this with somebody else that you think would get a lot of value. Trying to find more ways to share and encourage the people around us to think about investing and take their financial future seriously as well. So anyone else you want to share this with them, like, subscribe, leave a comment, all the good things. And yeah, we'll see you next week.
See you next week. Bye, guys.
Bye.